Julia, okay, what's your takeaway from all this?
Well, we think that the big focus for next year will be one of central bank divergence. So you can see that in Asia, you can see Korea, you can see New Zealand. They're hiking for, of course, there are global reasons like inflation, but also domestic reasons like labor market running very hot, being susceptible to commodity price inflation, and also financial stability concerns, which I think matters for Korea as well. So we will see these central banks moving ahead. But on the other hand, we will see some central banks, the bigger ones like the Fed and ECB, holding on to a more gradual path of normalization. So we think that these central banks have a lot of inflation credibility, and if you look at supply chains, there seems to be some signs that certain bottlenecks are starting to ease. So we do think that if these two big central banks hold, which matter for global financial market, that is still a key assumption for us as we look ahead to have a more pro-risk view for 2020.
And how the best to price that then? Is it going to the dollar, selling tech? That would be a reversal of the trend that we've seen this year.
Yeah, I think in terms of interest rate volatility, being long the dollar is one of our top convictions in this environment. If you think that Treasury yields are moving higher, even though we don't think the Fed is hiking, clearly there's something happening with market expectations. So you see that rates moving higher. So dollar could perform, but we think that if the Fed ends up being more accommodative as we expect, we think there's actually a pro-risk environment generally, and it should be good for global equity market, particularly developed markets.
What do you think then is behind, this goes into that view of whether it's a tail risk or a base case expectation if the dollar goes higher. What's behind this recent move up in the US dollar, especially also when you look at 5-year yields? They've also been picking up.
Yeah, I think there are probably several things. The most important thing is actually the U.S. economy, I think, recovering from the Delta impact over the summer. The U.S. is still in, I think, a relatively better position vis-a-vis many other economies in terms of policy resources, their ability and willingness to support demand. So we should see that reflecting in the strength of the U.S. economy and reflecting, therefore, in the strength of the U.S. dollar. And of course, interest rate expectations also play a role, and especially when it comes to short-dated treasuries. But I think that economic rationale is why we think that broadly next year should still favor a stronger dollar in mid-cycle.